You started a 1099 job or a side hustle, and suddenly you owe the IRS way more than you ever did as a regular employee, even at the same pay. You're not imagining it, and it's not a mistake. There's a real reason 1099 workers owe more, and once you understand it, you can fix it. Let's break it down. First, the basic difference. A W-2 is what an employee gets. A 1099, usually a 1099 NEC, is what an independent contractor gets. They look like two versions of the same thing. But for taxes, they put you in two completely different worlds. Here's the first reason you owe more, and it's the big one. Everyone who works pays Social Security and Medicare tax, totaling 15.3%. When you're a W-2 employee, your employer secretly pays half of that for you, 7.65%, and you never see it. When you're a 1099 contractor, you are the employer. You pay both halves yourself. Here's the actual form. This is a 1099 NEC, and Box 1A, non-employee compensation, is your full pay. Now compare that to a W-2. On a W-2, Box 2 shows the federal income tax your employer already withheld. On a 1099, nothing is withheld at all. The whole bill is waiting for you at tax time. And that's the second reason it feels so much worse. Nothing is withheld. A W-2 employee has income tax pulled from every paycheck automatically, so by April, it's mostly paid. As a 1099 worker, you get your full pay up front, spend it, and then face the entire year's tax bill at once. Same income, very different feeling. Let me show you the gap with real numbers. Take a W-2 employee earning $60,000. Their share of Social Security and Medicare is about $4,600, and the employer quietly pays another $4,600. Now take a 1099 contractor with $60,000 in profit. They owe the whole amount themselves, about $8,500 in self-employment tax. That's roughly $4,000 more just in payroll tax. So if someone offers you the same number as a W-2 job or a 1099 gig, they are not the same offer. As a contractor, you're taking on the employer's payroll tax, plus you get no benefits, no paid time off, and no unemployment insurance. A common rule of thumb, a 1099 rate should be meaningfully higher than a W-2 salary just to break even. Now for the good news, because it's not all bad. The 1099 world comes with a powerful advantage a W-2 employee simply does not have. You can deduct your business expenses. A regular employee generally can't write off unreimbursed job costs at all. But as a contractor, every legitimate business expense lowers your taxable profit. Look at what you can write off as a 1099 worker. Your mileage at 72.5 cents a mile for 2026. A home office, the business share of your phone and internet, supplies, software, and equipment, self-employed health insurance, and big retirement contributions through a SEP or solo 401k. Each one lowers both your income tax and your self-employment tax. There are two more built-in breaks for the self-employed. You deduct half of your self-employment tax automatically, and the qualified business income deduction can take another 20% off your business profit before income tax. Stack these with your expenses, and the gap between you and a W-2 employee shrinks fast. Now watch what those deductions actually do. Take that same $60,000 contractor, but this time they track $12,000 of real business expenses, mileage, a home office, phone, and supplies. Now they're taxed on $48,000, not $60,000. That shrinks both the self-employment tax and the income tax, and suddenly the gap with the W-2 employee is much smaller. Sometimes, the contractor even comes out ahead. And here's an advantage almost nobody talks about: retirement. A W-2 employee's 401k is capped at the employee limit. But a self-employed person with a SEP IRA or a solo 401k can set aside far more, potentially tens of thousands of dollars more, which lowers this year's tax bill while building their future. For higher earners, this one perk can flip 1099 from a burden into a real edge. But one serious warning. Some employers hand out 1099s just to dodge their share of payroll tax, when the worker is really an employee. If your boss controls how, when, and where you work, provides your tools, and sets your schedule, you may be misclassified. You should not be eating the employer's half of the tax for what's actually a W-2 job. If that sounds like you, the IRS has a form, SS8, to determine your real status. So how do you actually fix the 1099 tax shock? For moves. First, set aside 25 to 30% of every payment for taxes in a separate account, so you're never caught short. That one habit prevents the April panic by itself. Second, pay quarterly estimated taxes. Because nothing is withheld, the IRS wants its share 4 times a year: April, June, September, and January. If you owe $1,000 or more and you skip them, you get an underpayment penalty on top. Paying quarterly keeps you penalty-free and the bill manageable. And don't forget, this whole conversation has been about federal tax. Most states tax your 1099 income too, and a handful of cities pile on their own. Some states even want their own quarterly payments. So when you set money aside, factor your state in. For a lot of people, the true set-aside is closer to 30% than 25%. Third, track every expense like it's money, because it is. Use a separate bank account and card for your business, run a mileage app, and keep your receipts. Every dollar you document is a dollar you don't get taxed on twice over. And fourth, as your profit grows, look into an S-corporation. Once you're consistently netting a healthy income, electing S-corp status can lower the self-employment tax you pay on part of your earnings. It adds paperwork and cost, so it's not for beginners, but it's the next level move worth asking a pro about. Quick recap. As a 1099 worker, you owe more for 2 reasons. You pay the full 15.3% self-employment tax, and nothing is withheld. But you fight back with deductions a W-2 employee can't take. Set aside 25 to 30%, pay quarterly, track everything, and consider an S-corp as you grow. One quick note on who makes this. The tax breakdown is prepared by a tax accountant with over 15 years of public accounting experience, so every figure here is checked against the IRS sources. Always educational, never advice for your specific situation. Bottom line, a 1099 isn't a worse deal than a W-2. It's a different deal. You take on more of the tax yourself, but you also get control and deductions an employee never sees. Understand the rules, build the habits, and you keep far more of what you earn. This is general education, not tax advice, so check with a pro about your situation. Subscribe to the Tax Breakdown for simple tax-saving tips before you file.